A lot of people have told me to watch this. I assume it is up my alley in a way. So Hank Green said, his title is, I'm changing how I manage my money because of AI. Now, I saw this in my recommended and I was not interested because I thought he was talking about like getting ChatGPT to pick stocks for him. But after all the recommendations, I assume that is not what it's about. That would be fucking crazy. That would be fucking horrendous, and I'm not interested in that.
You today. I want to start out.
Okay.
I probably have to say this legally. I'm not a financial advisor. I do not understand what financial advisors do or what is the best way to invest your money. I am simply a man who has money invested for retirement and has paid attention to how that has gone for people over the last 30 years or so. Okay. And one thing that has become obvious, if you were disciplined over the last 30 years, and of course past performance is no guarantee of future returns, but if you just made sure that you were invested broadly in the stock market, things went well for you. If you spent all your time like buying and selling and day trading and trying to figure out the best stocks, probably you underperformed the market and you spent a bunch of time focused on something that wasn't adding that much value to the world. But also, if you worked with someone else who was doing that for you, that probably also didn't help very much. Now, if those people made sure you were invested in the market and you didn't have money just like sitting around doing nothing, then they did help you. If you would have invested that money anyway, the percentage points that they would have taken off the top for managing your money probably made it so that you would have less money than if you had just done it yourself. I said, done it yourself. What is it? Well, I can tell you, for the last 30 years, it has been buying what is called a low-cost U.S. equity index fund. Let me break that down for you. Index fund means you're not paying someone to guess which stocks will win. The fund simply follows.
When does he talk about crypto and how that would be a better choice? This is not going to be like about buying VU and holding, right? It's going to be about soon. So he gets to that? Okay. When does he mention a 50-50 split between sports parlays and Shiba?
A list of U.S. companies like the S&P 500 or the entire U.S. stock market. It's a way to invest in the market itself rather than trying to outsmart it. Low cost means the fund takes very little off the top, often just a few dollars a year for $10,000 of investment. That's a big deal because over decades, even tiny percentage fees compound, just like any percentage can compound. It can quietly eat away thousands or tens of thousands of dollars from your future. And U.S. equity means the fund like indexes to some market of American companies, from tech giants to banks to manufacturers and retailers, giving you a slice of the whole U.S. economy in one simple investment. Now, some funds focus on different parts of the market, like some focus on the biggest players, others spread your money across thousands of companies, large and small, but you don't get like an equal amount of every stock. This would be silly and it would break everything. The index fund indexes to the market capitalization, which is just like the value of each.
Just to be clear, it wouldn't break everything. There are equal weighted funds and they don't break. They're fine. You can do an equal weighted fund. It doesn't have to be market cap weighted like most funds. When you say the return is lower, you are saying it like each fund has a guaranteed return that you're just picking from and you just pick the highest one. Past performance is not indicative of future results, obviously. Yes, the market cap weighted ones have done better. That's correct.
Company. And that means the bigger a company is, the more total stock value it has out in the world, the bigger it has of like a slice of your pie. Example, if your index fund indexes to the S&P 500, which is just like a list of the 500 biggest companies in the US.
Which, just to be clear, is like almost everybody's. Not even in America. Like people's retirement funds in Scandinavia is in the S&P 500. A lot of the world is putting their financial assets for retirement in the American S&P 500, market cap weighted. So it's buying most. I assume he's going to, because based on the title and how this video started, I'm assuming he's going to talk about how, everything's in top 7 stocks. But just to be clear, that is not just it's not like you didn't pick a random one out of the hat. This is like the one. Everyone is doing it.
And Apple makes up 5% of the S&P 500 by value, then about 5% of your money goes into Apple. A big drugstore like CVS is big. It's going to be on the S&P 500, but it's much smaller than Apple. So you're still going to own some CVS, but it's going to be like a tiny fraction of a percent. This way, your investment naturally tilts toward the companies that carry the most weight in the economy, because that's how the economy itself is shaped. And as companies rise and fall in value, the fund automatically shifts with them. No one's trying to outsmart the market here. The fund is just riding the market. So what everybody says who's like not trying to sell you something is the thing you should...
Just one more thing to say on that. And sometimes I feel like people don't understand it. They think that there's a guy at Vanguard or there's a guy at Fidelity who's like keeping an eye on it. It's like they're making sure it's tracked. It's completely It's completely a mindless robot. You give it money, it buys. It always buys. It buys no matter what, market cap weighted. So it just buys the biggest companies. That's all it does. I'm not saying it's bad. It's worked. But you just have to understand that, like, if there were a problem or if it was too concentrated, this would never know. It would always just take your money and buy the biggest stocks.
Do is to buy a low or zero cost US equities index fund, and that should be where all your money is. Because the great thing about these simple index funds is that finance people don't get to take a cut. So it's a way to be diversified and just have a slice of the whole American economy without paying like finance people to like figure out exactly how to try and win over all the other finance people who are trying to win. There are a bunch of funds that are managed super carefully, and they're smaller, and they're a lot of work for a lot of high paid people. But big index funds are simple, mass market products, so companies like Fidelity and Vanguard make them available very cheap or even for free. For me, over the last decade, most of my retirement money has been in a low-cost S&P 500 index fund. It's very low stress. But I do invest some of my money personally, and one thing that I found in doing that is that I worry about it all the time. Like, I worry if what I've chosen to do has under or overperformed the S&P 500, and it's been like both. Like, it's been way above it and it's been way below it. It's like so volatile compared to just buying the market and waiting. So there's two big problems with investing my money personally. First, my life has never been improved by worrying, and it increases my worry. Second, it becomes like a job, and I don't want managing my money to be my job. I want my job to be my job, because managing money doesn't feel like it actually adds any value to the world. So that's what I've been doing for the last 10 years. It's turned out well. But I have decided to make a change. And this is a big deal for me. Now, it's not super huge, but I'm going to explain it. And you can do whatever you want with that information. So again, one of these US equities index funds is buying all of the stocks that fit into the category, but it's weighted to the size of the company. So Google is on the S&P 500 and so is CVS. But of course, I don't own an equal amount of CVS and Google. Google is like 30 times bigger than CVS. So the index fund tracks that, and owning the index fund means that I own 30 times more Google stock than I own CVS stock. This is fine. This is how index funds work. It's how they're supposed to work. It's how they perfectly track the growth of the index. But over the last 10 years, especially over the last 5 years, the percentage of the S&P 500 index fund that I am invested in, that is in the 10 biggest companies in that fund, has gotten very high. Yeah. It's now like 38%. So buying the index fund is like a way of diversifying in 500 different...
You might mention this, but it's worth saying. NVIDIA recently hit, as an individual stock, 9% of the fund. Like the highest any individual stock has ever been of the S&P 500 ever in the history of the thing. There's 500 companies and one of it is 9%. That's so it's I don't know if he'll mention it because this video is a few days old and this is like a day ago. You know, it's not as bad as Nortel was in Canada, to be fair. And again, NVIDIA is a great company. I'll never denigrate it, but that's an absurd ratio. It puts a lot of risk on you. You know, a lot of people's retirements is buying into NVIDIA specifically. It's a single point of failure. Could you give a comparison to Cisco? Well, Cisco was never even the number one. At the peak of the dot-com bubble, I think Microsoft was 4% of the index. Something like that. Maybe Microsoft and Cisco were both around 4%. But so NVIDIA alone being 8 or 9 is it's pretty wild historically. It's pretty wild.
Different companies, but 38% of my money is in 10 different companies. Also, most of those companies have grown a lot recently, including NVIDIA, and they're betting very heavily on AI. The AI boom, which I personally consider to be very speculative, potentially a bubble, has made it so that NVIDIA alone is 7% of the S&P 500.
All right, so it's a little higher than that, Hank. I'll get a chart so you know I'm not blowing smoke up your ass. I think it actually hit 9. I might be fucking crazy. Look at this. Isn't this absurd? So this is the highest percent a single stock has ever hit. So the second most was Apple in 23, Apple in 24, Apple in 21, Apple in 22, and Apple in 20. So in the past 5 years, it's basically NVIDIA and Apple. But then before that, we haven't seen the concentration this bad since the 80s with IBM. And that was, significantly less. It's clearly a trend towards consolidation. And the PE ratio of NVIDIA, which is like its price, how much it's valued based on how much it actually earns, is really high, higher than any of these like dominant companies in the past. Again, ExxonMobil in 2010, if that's the most valuable company and it's 4% and it has a PE ratio of 12, that's pretty safe. But 58, as good as the company is, that's risky because the price of it is not backed up by its earnings. So just worth noting. But yeah, I agree with everything he just said, low key. Maybe I'll just let him talk because he seems like he's got it all.
500. And one of the big reasons I like being in a broad index fund like
what is PE ratio? I know I've talked about it before, but maybe just a quick primer because I think it's really important. I think it's good to know. PE ratio is just price divided by earnings, which very simply is what is a company worth and how much does it make? You could say stock price, but really it's the value of the company, to be honest. It's like if NVIDIA is a $4 trillion company, it's worth $4 trillion by the stock market. I don't know how much it makes, but whatever it is, it's like 50 times less, right? So that's the idea. If the number here is a lot smaller, then earnings like revenue or profit. So that's the idea, is like a PE ratio is basically saying, now, generally in the past, companies have high PE ratios, like their price is way higher than what they make when everybody thinks they're growing like crazy. It's not wild to have a high PE ratio for a short period of time, but it's a sign of risk because you have to keep growing. Again, NVIDIA at $4 trillion with a 60 PE ratio basically means it better grow like crazy just to get to here. But you assume if they report results where they're going like crazy, that price is going to go up too. And so it just adds some risk. They have to do even better than they're doing now. That's why it's risky. So their forward PE is 40. It's correct, but that's high. That's still high. That's still high, and it's optimistic.
This is that it is diversified, but now it's just not that diversified. Nearly 40% of the value is in 10 stocks. That's a historic level of concentration, and inside of those 10 stocks are a lot of companies that do very similar things.
With a PE ratio of 56, does it mean they would need 56 years to make the amount of money that they're worth? Essentially, yeah. It's if you were to buy in at this price, think about it like, a great way to think about PE ratio is like a vending machine. Think about it like you're buying a vending machine. Let's say you buy a vending machine for $2,000 and you set it up and it makes $200 every year. So it would take you 10 years to get your money back. That's the idea. At the current valuation and the current amount of money it makes. So obviously, if a company like NVIDIA has a PE ratio of 60, here it costs you $60, it makes $1 a year. If no one wants to wait 60 years, so what they're estimating is that this number will go up. The amount of money it makes will go up so much that it'll make this worthwhile. Palantir, for example, right now, I think has a PE ratio of like 150, 200. It's absurd. But they're assuming there's going to be hockey stick exponential level growth of the amount of money they're making, which can happen. It does happen occasionally. It's not. But when you get to companies that are this big, the idea that they're going to like double and triple the amount of money they're making starts to get scarier because they're already in that upper echelon. Palantir PE ratio is over 600. Yeah. I mean, over 600 is like really absurd. Like you have to really bet that they're going to that company's going to make so much more money. So much more. Like they're going to have an unexpected massive increase in like the amount the business makes a year. It's worth understanding. Again, PE ratio is not the end all be all. And actually in recent years, it's kind of become a little broken because investors no longer buy a company expecting to receive a cut of the profits. That was what companies used to be. It's like you buy a company like Coca-Cola, you buy a share of it, and then you get a cut of the profits and you get your money back. But that no longer anyone does that. Everyone just takes the extra money and buys their stock back to pump it up. So we're in a weird environment and PE ratio is less applicable, but it's still a great way of estimating how much growth the market is baking in. It's like expecting to happen. Okay, back to Hank Green, who might just say all this.
Things. They're Microsoft, they're Nvidia, they're Google, they're Amazon. I feel like my money is more exposed than I would like it to be. I feel like by virtue of having a lot of my money in the S&P 500, I am now kind of betting on a big AI future. And that's not a future that I definitely think is going to happen. So I'm taking 25% of the money that I have invested in the S&P 500 and I'm going to put it in a mix of different things. Some of it is going to go into an S&P 500 value index fund, which takes off some of these higher performing stocks that have really high price to earnings ratios. Some of it's going to go into mid-cap stocks, which are just smaller companies that have smaller valuations. And then for the first time, and I've had people like say that this is a good idea no matter what, I'm moving some money into an international index fund that just represents the...
Yeah, I was going to say, diversifying out of the S&P 500 into the S&P 500 with 25% of your money, the cross correlation is really high. So even if you buy a fund that doesn't buy Nvidia, but it's buying the rest of the S&P 500, if Nvidia tanks, the market is going down with it, the American market. So, my response would be, I think this is the right thought. But what you really want is like international ex-US. You want like a world fund ex-US. If you're going to have the S&P 500, you really want a fund that is entirely removing US stocks. That's what you would want. Not even a world fund, because a world fund is still mostly America, and that's mostly the Mag 7. Okay? I just want you to understand, like, if you buy a total world fund and SP 500, I'll give you a great example. We can pull it up right now. Like, what is the Vanguard World Fund? This is the Vanguard Total World ETF. This is a bit of stocks from all over the world. What is the highest holding, do you think, of this fund? It's Nvidia. Next highest is Microsoft. Next highest is Apple. Next highest is Amazon. Next highest is Facebook. Next highest is Broadcom. Next highest is Alphabet. Next highest is Tesla. Okay? So, you're more diversified, don't get me wrong, but you're still hitting you're making the same AI bet. Again, all these is an all AI bet. So what you really want is a Vanguard, world ex-US fund, and you can pair that with the S&P, and then you're more truly world diversified. And those ex-US funds exist. I don't know. I'm not a financial advisor here, but like Vanguard World ex-US ETF. Yeah, here we go. This is this one right here. Okay? This is not a recommendation. I'm just saying an example. But like this fund is not going to have, it's going to have Nestle and Alibaba and Tencent and Novo Nordisk. You know what I'm saying? This is the biggest holdings and they're much smaller. So this is a truly diversified fund, but you're missing out on the incredible returns that have been available in America. So you can kind of pair S&P 500 in this. Not financial advice. I'm just saying this is more diversified. Do you understand? This is not being hurt by AI nearly as much. If AI, there's a bubble or whatever, this is not nearly as impacted. Tencent and Alibaba is also AI. Tencent and Alibaba are companies that are talking about AI, but Tencent's revenue is entirely from games, gotcha games. That's like they'll be fine. And Alibaba again is an Amazon competitor, and so that's so why not buy a total world fund by itself? Again, that's also fine. I think that's what I recommended I made a video similar to this video not too long ago, actually a few months back, but it had a terrible title. It was called Actually Great Point. Oh, Reddit. There's some certified fire. Okay, I'll talk. It is about this. Stocks or are investing. They'll ask this question like, why do I pick S&P 500 over the world? So you can watch this if you want to see some take, but yeah, you could pick the world, but understand the world is still hitting these S&P stocks. So just worth understanding. Again, some of you are very confident that this will work, and it may. Fuck, it's been working. People that thought like this too early have missed out on generational runs in these tech stocks, but it is all concentrated right now in one big bet on AI with the Mag 7. Okay, let's go back to this Hank Green video.
The world's economy rather than just one country's, which is another kind of diversification. And I also have, and this is where you shouldn't listen to me, but I also have some logic as to why to move into some percentage of my money into small cap stocks. First, the S&P 500 has grown a lot over the last 5 years, just a huge amount. And the price of the stock versus the earnings of the companies that ratio is out of whack. Now,
there you go, PE ratio. One thing that's also worth saying is that I think, and I could be wrong, let me check, make the stat right before I say it, but the United States has never been a smaller share, at least since World War II. It's never been a smaller share of the world economy and never been a larger share of the world stock market. I think it's something like 65 or 70% of the world stock market. Yeah, here's a good graph. This is our percentage of the stock market, but our percentage of the economy has never been smaller. So it just feels a little out of whack. Everyone around the world has now dumped their money into US stocks because they've done well, and they do well because everyone dumps their money into them. It's a very self-perpetuating cycle. Everyone has seen US stocks do good, so they buy US stocks. So they do good, so they buy US stocks. So, but it's diverged from the fundamentals. And this could go forever. I have no idea. I'm not making a call. Really, I think when I talk about the economy, I'm just ignoring the stock market because it's so divorced from regular people's economic reality that I've just stopped talking about it. But as a investment philosophy, it's just worth noting this. This is like what's EM? Emerging markets, like Brazil. Back to Hank.
It might be that this all makes sense and that they'll have the AI war, and at the end there'll be just a ton of winners and they'll just explode in value. But this absolutely seems speculative to me, and I remain unconvinced that AGI is nearby, and also, even if it is, that it will be tremendously economically beneficial to the companies controlling the models themselves. This is something that I'd like to make a video about. I don't know if I know enough about it to do it, though. You don't really have to take my word for this. Like, you could totally disagree, and I would be like, yeah, you're probably right. But I'm worried that my money is concentrated in a sector that is speculative. Now, second, why small cap stocks specifically? They have not grown very much in the same time period, and the valuations of these companies are not similarly inflated. Like, the companies are valued more like normal companies. They don't have these weird price to earnings ratios. And because of that, they're not going to have to do a bunch of like weird high performance, high risk, high reward backflips over the next 5 or 10 years to justify their valuations. They're just going to have to be themselves. And third, this is probably my most controversial take, but
he might be right, by the way. I personally have been wary of US small caps because I think in the United States, all smaller companies are being truly eaten by big tech. I don't know that it's a great bet, but I could be wrong. Again, you know, when everyone's telling me it's terrible, then maybe it's good. But I get the feeling that US small caps they have to become like a loved sector. People have to start putting their money in it for it to go well, and I just think it'll be tough to do that. What does eaten mean here? I mean, all of their excess profit is eaten up. Here's a good example. Most small businesses in America are required to advertise to get their message out there. And when they advertise, they have exactly 2 options to choose from: Google or Facebook. So this duopoly has continued to raise prices on online advertising. And for most small businesses in America, a huge chunk of their customer acquisition cost is just throwing money at Google or Facebook. So it's hard to imagine all the excess profit kind of just getting sucked up. You know, it's like you'd rather own Steam than any individual indie company, unless you can pick one right. Most of the money just gets sucked up by Steam or by Apple as the App Store. It's just when it becomes a tax like that. Anyway, that's neither here nor there. I think it's a fine thing to do, but I don't know if it's diversified enough from the S&P 500.
I think it may be that the majority of the value of AI will flow to smaller companies rather than big ones. Now, this never happens, so why would it happen? If there was just one big company, I'd be like, okay, well, we're in a lot of trouble. But what it looks like is there's going to be a bunch of, there's Gemini, there's ChatGPT, there's Claude, there's others. Microsoft has one that I can't think of a name of. There's a bunch of these companies.
Copilot.
They all have different models. My guess is, and this is where I get super speculative, my guess is being the best AI model will not be that much better than being like a value, like a cheap one. I don't know. I could be wrong, but I feel like these big companies that are spending, billions and billions of dollars might get a lot of competition from people who are just taking advantage of the innovations that will happen over the next 5 years and just compete with them without having spent all of the money. And so they won't have this like weird cap table. They won't have all the loans. They won't have all of the infighting. They won't have these lunatics in charge. But again, What do I know? But I just think that it's totally possible that AI will just be like a tool. It'll just be a tool that engineering companies use to develop new materials and drug companies use to develop new drugs and stores use to manage inventory better. And I think that these giant companies providing the AI models will actually be competing with each other for those customers, in part by competing on price. And that might mean that the value delivered to small companies will be bigger than value delivered to the big AI companies. Who knows though?
I'm not 100% sold on that theory, but you know, his first part was what I loved. It's just like, hey, I don't like all my money being concentrated on one bet when I think it's diversified. You don't have to make a prediction in the future. You don't have to know how AI is going to play out. You don't have to be like, oh, I think it's going to work out this way. That's hard to do. No one knows. But it's just, you know, the simple idea that he had in the beginning, which is like, hey, I want my money to be diversified so it retains its purchasing power. I don't like making such a big bet on one sector. I think that's just a good thought, whether or not you're right about this theory.
Thing that could happen. And if I'm wrong, 75% of my money is still in the safe place that everybody says your money should be, which is the S&P 500. But I do think it's possible that we're gonna see a world where AI is a useful commodity and the companies providing it will be competing for the business of many companies, and they'll all make money, but the AI companies aren't gonna become like gods. Now, you might be thinking, why not move all your money into small cap stocks? Well, because I think that would be very risky. I'm not an expert, but I've not seen many experts say that you should do that. Returns in the Russell 2000, which is like a small stock index fund, have been half of what they have been in the S&P 500 over the last 10 years. So it certainly would have been a bad idea to have any amount of money in the Russell 2000 over that time. You would have made half as much money if you'd had it in the S&P 500. So like, I don't know.
Well, also, I mean, it's just worth saying that the Russell 2000, which is like America's, you know, it's like the bread and butter of America. It's like everything outside of our biggest companies. It's not doing so well. The Russell 2000 is a good indicator of an economy that's not succeeding for most people. The Russell 2000, they're not showing crazy earnings growth the way Meta and Google is. You know, it's weaker manufacturing, it's weaker home construction, it's weaker real estate sales, weaker auto insurance, weaker auto loans, it's just the bread and butter shit of America. And all of it is doing relatively mid to poor. So will that get better in the future? Maybe, but I don't think you're buying the absolute dip here. So again, if I were to just slightly push back on this video, I would say, I think really consider a world ex-US fund. Just totally get out of the US. You're much more likely to have, you know, let's say there's a world where the tariffs really hit and it really fucks America's economy and we take a hit or whatever. It's all going to be cross-correlated if you're buying different sectors of the United States stocks. But if you own like things entirely different, Brazil stocks or whatever, it's more likely you'll weather the storm or even see growth. That's my honest take. But again, not financial advice. Totally feel free to do something differently. I actually secretly recommend putting it all in on Doge. That's a blue chip crypto you can hang your hat on. If the American economy takes, haven't we seen that impact the rest of the world? Absolutely. But I do feel it's a very safe argument to say that a lot of America's damage is self-inflicted, and the trade war stuff could lead to boons elsewhere.
I'm not smart enough to feel comfortable taking that kind of risk. But this just seems to me like something I kind of have to do because I'm not comfortable with the lack of diversification in the S&P 500 index funds and how many of those companies have very high price to earnings ratios, and how those same companies that dominate the S&P and have high PE ratios seem like they would be pretty negatively impacted by a potential future where AI turns out to be an important commodity rather than like a massive world-changing economy exploding super intelligence. And I actually think that second outcome literally just isn't as likely. I know everybody in the AI world, like they're all over there in San Francisco being like, man, everything's about to end. The singularity is now. We're on the droop. The curve looks like this and
it's just so much easier to be skeptical of those people after ChatGPT 5, which was just not revolutionary in any way. It was really incremental. And in fact, deeply feels like a cost-cutting measure, a disguised cost-cutting measure, which is more of a sign of worry of like, oh God, this costs us so much fucking money. This is the classic hype cycle. You learn this in marketing for new technology. It feels like we were here, and maybe, just maybe, ChatGPT 5 is putting us here. Do you know what I'm saying? Not that AI won't do insane things in our lifetimes, but people were talking about how AGI next year, bro, it's all, you know what I'm saying? I get the sense that this cycle is not different this time. That's what I get, the cycle that it's not different this time. That's my true opinion. That people will always get overexcited. And they will always overbet, and they will always, and I don't think they did anything different in this situation.
This part right here. But look, if that's where we're at, will there be money in the future? Will any of it matter? I don't know. I don't know. I don't know. I don't know. It's also weird for me to make this video. I'm not a finance YouTuber. I'm a science YouTuber with a side of whatever I want to do today. But I felt like this was like this is a big change for me.
I think it's good. I'm glad he made this video. I think he's got trust with a lot of people, and I think he makes people think about it. I think, I've wanted people to think about this for a long time. I think it's worth taking a look at. I think a lot of people are driving headfirst at the wall because it's worked, and they just la la that they, you know. Historically, the good times don't last forever, you know, and especially with all these storm clouds, it would just be nice to be a little more diversified.
Pretty much just buy a market index and hold it. So actually making a choice feels with a significant amount of my savings.
Okay, last thing. Well, let him finish. I have one counterpoint though, because I think I agree with Hank Green's thesis here, and I've made my point. But I'm going to make a strong counter argument just so you can hear both sides and then feel stuck.
It's a really big deal. And I felt like, okay. I don't know, I should share. And look, maybe I shouldn't because I could be totally wrong, but I felt like I should share. It just, what I do know is that I have many times said to people, just buy S&P 500 and hold it. And now I'm like, okay, I'm going to keep doing that, but I'm also going to do a second thing because the market cap of the S&P is so focused in the top 10 stocks and so focused in a particular sector, which is AI, which is not a sector that we know about. It's not a mature sector. We do not know what it's going to be. So it just seems risky to do the thing that I have been doing and have advised people to do many times. And so I made a video about it.
Okay, good video. Thank you, Hank Green. Slight counterpoint. Let me give you the counterpoint. Let me give you the strongest steel man. Because, you know, if it was that easy, then everyone would just jump over. Here's the steel man. And this is what makes it hard for me, because I agree with you. The 7 companies we're talking about, NVIDIA, Microsoft, Apple, Meta, Google, they are reporting blockbuster earnings. And that means they're consistently making more real hard cash. They are growing. They are making more money. They are taking a bigger slice of our economy. The AI stuff is still a money loser. They're not really drawing a good connection between all the money they're dumping on AI and their profits. But at the end of the day, they are extremely profitable, extremely powerful companies. It's not very .com where it's all smoke and mirrors. It's all fluff. The biggest risk actually is NVIDIA, because if the AI spending spree slows down, the entire NVIDIA story makes no sense. NVIDIA is predicting more and more chips sold every year, and they're already selling a bazillion. It's worth noting that. That's one small counterpoint. And the second small counterpoint, actually, this is the big counterpoint. This is the real counterpoint. The real counterpoint is that if we have tough times, if the AI bubble is like the .com bubble and it bursts, if the economy is weaker than actually expected, if job numbers start to slow, if spending starts to slow, well, it turns out in truly terrible economies, the stock market can go up for a long time. This is the Argentina stock market during absolutely horrendous years for the economy. Hyperinflationary years for the economy. This is their stock market. And so bad times can often lead to absurd amounts of government bailouts, government money printing, that the economy's worse than ever. The price of goods is hyperinflationary, but the stock market rises with that. Are these numbers just as inflation? No, but they rose with inflation. Like if you were an Argentinian and you put your money in the stock market, your purchasing power stayed basically the same. Do you understand? But if you just kept it in cash or in bonds, you would have lost all your money. It's worth noting that, like, if an environment is approaching where the US is going to print, holding equities and holding things like gold are actually, you know, I saw Edward Chancellor, who's an extremely wise financial writer. He wrote Devil take the hindmost. He wrote The Price of Time on interest rates. He said his portfolio is 50% equities, 50% gold because of that exact situation. So it's just equities and stocks. So it's worth noting that that's a fair argument. It's a fair argument that inflation, you actually want to be invested in companies. So it's fair. You know, a normal crash is a symptom of normal times, and we're not in normal times. So just worth saying, just worth pointing out. I like the video a lot. I still think having some of your money, if you're going to do the index fund thing, be in world x US to balance out S&P 500 is really smart. I think it's a really smart thing to do. Couldn't hurt. Can the US not print anymore because we would have hyperinflation and the USD might not stay the world currency? That is Edward Chancellor's theory. That would be that guy's theory. His theory is that the United States is at the end of a debt cycle. The debt is too much. Debt is impossible to maintain. And we will have to slowly start not even slowly, quickly, have to start printing more just to pay the interest on our debt, which will then get worse. And we have to print more to pay it, which is going to lead to a time where you don't want to own like bonds, I guess. Long-term bonds, not short-term bonds. What is the counter argument to buying Bitcoin? So the arguments for Bitcoin are the same as the arguments for gold. The same. And I love gold's arguments, which is why I have some. And so you'd think I like Bitcoin. The problem is gold has 5,000 years of history of performing the way it does as a hedge against inflation or hyperinflation or in tough times. Gold has solidified its place in history as a maintainer of purchasing power. And Bitcoin doesn't have that long history. Bitcoin has only been successful during really good times. It's only been green lights. It's only been the easy money, free money era.